my mic on? There we go. I'm going to call the meeting to order. And as usual, I think we'll just start with introductions. I'm Chris Christensen. And
Jack Balcom.
Bill Wilkes.
Tom Bolin from town.
Judy Noel, Cambridge Trust.
Lindsay Donovan, Cambridge Trust.
And Eric?
Eric will be
You're going to call
by
him in a couple of
telephone,
minutes?
yes.
Okay.
Are we ready for him?
In about 2 minutes. We're just going to take a look at the minutes of November 30th. Do we have a motion?
I move we pass the minutes of November 30th.
Second.
All in favor?
Aye.
Aye, 300. Okay. Fund management discussion is next on the agenda, so we'll take just a minute to call Eric. Is that the plan, or?
That's the plan.
Okay, and you're just gonna put him on cell phone and just put it next to the speaker on your microphone?
Hello.
Good morning, Eric.
Good morning.
Lindsay and I are here at the Merrimack Trustees meeting.
Okay.
Good morning, Eric.
Good morning, everyone.
Good morning, you're on television.
Great. Oh, they got my good side, right?
Yeah.
Sorry I can't be there in person. I'm in Lake Placid for a hockey tournament with my son.
Oh, great.
Wow.
Yeah.
Sounds like fun.
Yeah. Long ride.
No kidding.
So everyone has the books before them.
Okay. I'm going to start on page 2. So I'm going to talk about the markets and the 3 equity portfolios, and then Lindsay will handle the other remaining portfolios. So on page 2, just to recap 2018, we'll talk more about the stock market volatility when we get to those slides. But just to note, if you're looking on page 2, the changes in the yield curve. So short rates went up about 100 basis points. Long rates went up about half to a quarter of that amount, mostly reflecting, concerns about, future growth in the U.S. You're starting to see some rolling over data in the global markets as well, and inflation really hasn't reared its ugly head yet. So the yield curve, for all intents and purposes, is flat or flattened substantially. If you look on the next page, on page 3, this is a measurement of the yield differential between the 2-year and the 10-year Treasury. That's 16 basis points. So the yield curve continues to, as measured by the 210, continues to flatten. And it's actually inverted. If you look at the 6-month out to the 5-year, is inverted. So short rates are higher than, so the 6-month and the 1-year and the 2-year are all higher than the 3-year and the 5-year. So there's a lot of different talks out there right now from strategists as to what that means. I think the main takeaway is the market is telling the Fed, you're done. There's no reason to raise rates further. You may have overshot with the last rate hike in December. However, you look at today's jobs report that was just released, as I was reading before the call, over 300,000 jobs were created in December. Unemployment rate ticked up to 3.9, and average hourly earnings increased 3.2%. So all this talk of a slowing U.S. economy wasn't evident in December, even though manufacturing rolled over a little bit. Higher, jobs growth, when the unemployment rate increases, that tells you there's a lot of people, that we're not at that full employment level that the Fed is talking about. So there'll be more debate in the next couple of weeks, but the initial response is, the 10-year Treasury is selling off. But looking on page 4, so what this chart shows you is what the bond market is pricing in for future inflation. So this takes the 10-year yield on the U.S. Treasury and subtracting out the yield on the 10-year tips. It's called the break-even spread. So that's basically what the bond market is pricing in for forward inflation. You can look in the fourth quarter here. It basically priced out inflation, went from over 2% to, this report was printed earlier this week, at 1.7%. So pretty massive bet on the bond market right now that inflation is not a problem. So I was talking earlier, if you jump to page 5, manufacturing indices. So this is the ISM Manufacturing Index. Still very strong. It has rolled over from the extreme peaks of 59 to 60, which those are unsustainable levels. Yesterday's report was 54.5. So still relatively strong manufacturing activity in the U.S., in the U.S. economy. Readings above 50 signal growth, under 50 signal contraction. The last time that reading was below 50 was back in February of 2016. So almost 3 years of an expansionary phase in U.S. manufacturing, and that's reflected on GDP growth on the next page, on page 6. So third quarters was at 3.4%, down from second quarter's 4.2. Q1 was at 2.2. So estimates for fourth quarter about that 2.5% area. So the Fed's mandate, just to jump a little bit here, is full employment and low inflation. So the Fed's mandate is not for financial market stability, even though they, in the past under Bernanke as well as Yellen, they put a focus on financial market stability. But the mandate for the Fed is low inflation, which is what we have right now, as well as full employment, which could be or near that full employment level. The next page, on page 7, is the leading economic indicators, still relatively strong, up 20 basis points in November. So you're not seeing any sort of leading indicators rolling over that's showing a U.S. recession or an imminent slowdown. And on page 8, this is the Fed's measurement of inflation. This is called the personal consumption expenditure. As of November, that was at 1.87%, so well below the Fed's 2% target. And as you look at the chart, it's very briefly only touched 2%. So the Fed's measure of inflation, the inflation in the market is not up to the Fed's level of inflation, even though they had four rate hikes, 4 tightenings in November. In 2018, they signaled 2 to 3 rate hikes in 2019. Bernanke and actually not Bernanke, Powell, as well as Bernanke and Yellen are having a sort of a meeting that all eyes are on today to see if Powell turns down the rhetoric of 2 to 3 rate hikes and says pause is needed. So I think that's what the bond market's anticipating is a pause language. If you look on the next page, on page 9. So this is as of Wednesday, what the Fed futures market is saying about Fed rate hikes. If you look under the column heading 2.25 to 2.5, so that's the current range that the Fed did in December, a 2.25% to 2.5% target for Fed funds rates. The meeting date's going down to your 2019 into 2020. And the percentages under that column indicate what the market is anticipating. So if you scroll all the way down, so you move out to a year from now, January of 2020, the bond market is saying about 63% chance that the Fed will stay in that level. If you look to the right, that's a rate hike. So the bond market for all of 2019 is not pricing in a rate hike. If you look to the left of that column, 2 to 2.25, the bond market has about a third of a chance that the Fed is going to cut rates at the end of this year. Again, these numbers will change as data comes out, but right now, based on the stock market volatility, the flight to quality, the rolling over of some economic data on the global scale, as well as some in the U.S., the bond market is telling the Fed you're done raising rates. So it'll be interesting to see if with Powell's statements today, if that rhetoric has changed from December when he indicated 2 to 3 rate hikes. Now, if it's turning to page 12, talking about the stock market, obviously a tremendous amount of volatility in the fourth quarter. Fourth quarter alone, the S&P was down 13.5%, wiping out all of 2018's gains. So for 2018, the S&P was down 4.39%. All of that loss. Remember, we had a very strong January, weak February and March, very strong summer. Third quarter was up almost 8%, gave it all back in the fourth quarter. If you look on the next page, on page 11, this looks at the international markets. Actually, the international markets underperformed the U.S. markets. Remember, they outperformed in 2017. So in 2018, the international markets were down about 9%, but they outperformed in the fourth quarter, only down 13% versus the S&P's decline. So a little bit of outperformance in international in the fourth quarter. The biggest question, is in a lot of investors' minds, and I'm sure in your minds, is what's caused this big sell-off. A lot of it has to do with Washington, the political risk of the Trump administration not being able to basically keep people in key positions, the revolving door of cabinet members, as well as the trade wars with China. There's some talks that'll be happening, upcoming talks in the next week or so, that maybe will shed a light on, hopefully some sort of a resolution. Apple pre-announced on Wednesday after the close significant revenue reduction as well as margin compression, citing China as the main culprit. So you're starting to see companies reacting. Apple stock is now down to its trading cheaper. It's down to its 2017 lows. So Apple's had a big sell-off, and companies that are missing guidance right now are being penalized because it's the fear of, okay, is Apple the start of a catharsis, or is it just one and you're done? And you also got to look at, from the March '09 lows to the end of the third quarter, the S&P was up over 300%. So we really, in this time period, it was basically a straight linear move. You had a couple of ebbs and flows, down 10% quarter, but there really wasn't this broad-based negative sentiment. And a lot of it's coming from Trump, as well as, the trade wars with China. That being said, the market as a whole, the stock market, is not that expensive. And what you've seen happen in the fourth quarter is you've seen, growth had really led the charge. You could say growth in those momentum stocks, so the FANG stocks became expensive, had really led the charge, and they corrected, or they pulled back, not to bear territory, but definitely a significant pullback. If you look on page 12, this is the growth versus value chart. So values actually started to come back into play, especially in the fourth quarter. And the three equity portfolios, so the principal, the income, and the scholarship, have a value bias to them, obviously, for the income generation of the portfolio. So those, we only have November 30th data, but when you look at the returns are actually very strong because of that flip from growth to value. As I mentioned earlier, when you look on page 13, so this looks at the price to earnings ratio, and right now it's trading at almost one standard deviation below its mean, going back to its almost 19-year average. So when we met back in the beginning of 2018, the S&P on a PE ratio is trading almost one standard deviation above the mean. Now it's trading one below the mean. And you remember when we had a conference call back in August, we actually reduced in the principal and income portfolios your equity allocations. Probably a little bit ahead, but we definitely protected on the downside by not being as invested in equities when we had this big sell-off. So with that being said, if there's no questions on the market and the economy, I'll jump to the portfolios on page 14.
Eric,
Yes.
how do you get an increase in the jobs and an increase in unemployment?
More people are looking for work than could find work. So it's actually positive in a nutshell that you're not at full employment, that there's still people who want jobs, that are actually looking for jobs and can't find jobs, even though 300,000+ jobs were created. So it's actually a very strong number. Surprising considering all the negative sentiment that the markets have experienced, and with some of the weaker economic data. This is a mind-blowingly strong number, in my opinion. And average hourly earnings growing to 3.2%. So all these fears of the market may be rolling over, or at full employment, we could start seeing employment, more layoffs coming. It's far from that. You're actually seeing people are actively looking for work, finding work, and want more work. So it's actually very strong.
But are they not? If unemployment increases, does that mean that these people were not recorded, and now all of a sudden somehow?
It means they're in the numerator, so they're in the bottom part of that equation. So they're actively looking for work and couldn't find work. So it's almost like they couldn't find jobs because there's not enough jobs, even though 300,000 jobs were created. So they're not giving up on looking for work. They're looking for work and couldn't find a job, even though we created more jobs. It was one of the strongest reports of 2018.
Okay.
Okay, so turning to page 14, we'll look at the Merrimack income portfolio. Looking at the asset allocation bar chart or pie chart on the top left, You see cash and enhanced cash. So we're grouping cash as well as enhanced cash. So any bond that has less than a 1-year maturity is grouped into that enhanced cash category. It's about 7% of the portfolio. Fixed income is 33%, and equities are right at 60%, which is the target of 60%. Again, we brought that back from, it was over 65% in the middle of the summer, so we brought that back to target, realized some gains, but obviously with the volatility in the fourth quarter, it definitely protected the portfolio. And if you look at the chart of the growth of a dollar, the blue line being the portfolio, and the index, you can see very nice outperformance, especially since in the last time periods there. You can see the year-to-date account flows on the bottom right. Beginning market value as of January 1, 2018, 2.7 million. Contributions less withdrawals of about 65,000. Income earned of 78,000. Minus the market appreciation of 82,000 gives you a total return of about 2.7%. That's for the full calendar year. Our year-end performance hasn't been audited yet. It'll probably be finished middle of next week, and we can email the year-end numbers to the committee. But if you turn to the next page, so this shows the actual percentage returns. These are as of November 30th. Just to highlight the year-to-date column, portfolio in total was up 4.8% versus the taxable moderate growth benchmark, which is a 60-40 between stocks, bonds, and cash. And the stocks being an 80-20 mix between the S&P 500, 80%, and 20% the MSCI ACWI-X-US of up 1.33%. See the cash and enhanced cash right in line with the money market returns. Fixed income, negative 45 basis points, right in line with its benchmark. And equities are up 6.99% versus a global equity benchmark of a little over 2%, S&P 500 up a little over 5%. So very strong stock performance through November 30th. And I would assume that, that delta, or that alpha that we have generated of almost 1.8% did not evaporate at all in December. As you know, more of those value names started outperforming. With this portfolio have a value tilt, I would assume that the performance, that delta in the alpha would still be there.
Eric, slow down for
Yes.
1 minute. I want to go back to page 14.
Page 14, okay.
So you say, the total market value is 2.669. The beginning value was 2.739. You have withdrawals 65, earned income 78, and you have depreciation in the value due to the market downtrend of 82. How does that equate to 2.94% portfolio yield? Is that portfolio yield
That's the
dividend income, or is that can't be an overall portfolio yield if you have a negative ending market value?
So the portfolio yield is the actual income earned between the stocks and the bonds in the portfolio.
So it's dividends in coupons, so to speak, on the bonds?
Correct.
But it has nothing to do with the value of the portfolio?
No, it does not. So what it does,
Okay.
it takes the annualized income of the portfolio and divides it by the market value.
Okay. I just wanted to follow that because it didn't make sense to me if the portfolio was worth less now than it was at the beginning.
Yeah, so that would be the total return calculation, not the actual portfolio's yield calculation.
And that's
So-
it's
so-
and that's
yeah,
not
so the
in
total
here.
return for the year would be slightly negative.
Yeah.
But again, we don't have the audited numbers yet, so it's not being reflected on that. Usually we show that at the bottom here, what the current year-to-date number is. But again, it hasn't been audited yet by our software service.
But we're talking 2.7% net yield over the total portfolio?
Well, 2.94
Yeah,
is what they're listing
Yeah,
here.
2.94 is the net.
Well, I thought
income
earlier
yield
you
of the
said
portfolio.
2.7, and I got the 2.94 here.
Were you seeing the 2.7?
That's
I
what-
just thought you said that
Yeah,
earlier, that's all.
that's what he said.
No, the net yield of the portfolio is 2.94%.
Okay. And my recollection is that's up a little bit over last year, which was 2.8 something?
It should be higher, yes, as bond yields have increased.
Yep, okay.
Yeah, just the cash yields are much higher than where they were a year ago. Money market yields are close to 2% right now.
Keep going. I just like to understand what we're talking about before we go too fast.
Yeah, no problem. Slow me down. I can't read. I can't tell how far if everybody's catching up or not. But on page 16, so this is the stock sector attribution of how we generated those returns. Just to highlight the column over, 3 over from the right, it says SEL effect. So that's the selection effect. So that's the true stock picking of the portfolio, the individual names and the set that we picked in those sectors versus the returns of those sectors. You can see that generated a 3.56% return. So the stock picking on the portfolio was very strong. If you look at the allocation effect, it was basically, didn't have that much of an impact to the overall portfolio. So it was more of the stock picking that generated those returns. And just to highlight, if you look under the columns variation weight and variation return, so that variation in the weight will show you where we're overweight or underweight those specific S&P 500 sectors. And the variation return shows the portfolio's returns, either positive or negative versus those S&P 500 returns. Just want to highlight, if you look at information technology, so tech obviously in the fourth quarter had a pretty big, sell-off. We were underweight tech in the portfolio, mostly by design, as the mandate or the strategy behind the portfolio is to look for dividend, yields that, dividend yields of stocks that can continue to increase. And a lot of tech names don't pay dividends. So almost a 6% underweight on average during that time period. But the stocks in your portfolio outperform, so the tech stocks in your portfolio outperform the tech stocks at the S&P 500 by 7.5%. So overall, the stock picking, even though we were underweight tech and didn't have exposure to FANG, the stocks that we had exposure to, Accenture, Cisco, Microsoft, all performed very well in 2018. So the main takeaway from this page is, the overweight or underweight the sectors really was a neutral to the portfolio, but it was the stock picking within those sectors was much better than the market as a whole.
I like that.
The next page, on page 17, just looks at the characteristics of the bond portfolio, and just to highlight the duration of the bond portfolio is 3.3 years. So the benchmark is 4. We still have an underweight versus the benchmark. Obviously, with the substantial rally we just had in rates, the bond portfolio kind of held its own there, or probably underperformed a little bit. But we've definitely been increasing our allocation away from corporates and more into governments and agencies. And the corporates that we own in the portfolio are still, very strong credit quality, and especially have a lower duration overall. And we've been trying to get more yield, more front-end yield with, shorter term agency securities. You can buy, right now in the marketplace, you can buy 2 and 3 year agencies that are in the mid 2s to the low 3s. So very attractive front-end yields. Obviously, as the yield curve has flattened or, inverted in the front part of the curve, those yields are much more higher than there are in long yields. So, if you look on the next page, I know it's hard to read on page 18, so this is a shock analysis of the portfolio. In most scenarios here, the portfolio performs very well, and that's due to the shorter nature of the portfolio. In the flattening of an environment, it has a positive total return if the yield curve continues to flatten from here. So just to highlight to the committee, even though the intent is to hold the bonds till maturity, doing so will result in positive total returns going forward for most interest rate shock scenarios that are presented there. Pages 19, 20, and 22, or the 23 are the individual securities held in the portfolio. Just some recent trades that we've made to the portfolio. We've actually increased or actually added to REITs, so it's the first time we've actually been buying REITs for these portfolios. Again, more of a defensive posturing to the portfolios as we move into 2019. REITs have been definitely under, trading very cheap, high dividend yields and are performing relatively well in this market sell-off that we've had.
Which REITs? I'm looking for them. Which REITs?
On page 23, we bought American Tower. And when we start going through the principal actually owns another REIT as well, which will probably be added to this portfolio as well in the coming days. That one actually owns Prologix as well, which is more of a healthcare technology REIT. So on page 24, we can start looking at the principal portfolio. So very similarly, cash is built up in the portfolio as we've been, more of our defensive posturing. So 7% of the portfolio right now is in cash. Fixed income is 28%, and equities are about 65% versus a 70% target. And again, this was very overweight equities as we moved into the summer, and we trimmed this back down below the 70% target. So as we, once we get the year-end numbers, it should have insulated the portfolio very well from the market volatility. And very similar, this has a portfolio yield of 2.73%. I'm looking under the account information on the top right. And you can see year-to-date in 2018, we generated about $326,000 in gains on the portfolio. Turning to the next page, on page 25. So highlighting the year-to-date column. So year-to-date, the portfolio was up 5.38%. This has a taxable growth benchmark, which is more of a 70-30 mix between stocks and bonds and cash. So a little bit of a higher allocation to the benchmark, to equities. And you can see overall the performance is a little bit higher versus the income account of 5.38%, well ahead of the benchmark of 1.55%. You can see the bond returns in the middle were positive 15 basis points through November 30th versus the bonds benchmark of down 45 basis points. And equities are up 7.02 versus the global benchmark of 2.02% and the S&P 500 of 5.11%. Very similarly, when we turn to page 26, looking at the actual stock attribution of the portfolio, I'm going to highlight that it's basically the mirror portfolio of the income portfolio. Selection effect, if you look down the bottom, because it has more of a higher allocation to stocks, that selection effect was a little bit higher of 5.51%. So stock picking is what really is generating the returns versus the asset, versus specific asset allocation or sector weights. Turning to the next page, on page 27, highlighting the bond portfolio. The duration of that portfolio is a little over 3 years, 3.05 years. Again, we've been adding more towards agencies versus corporates in the portfolio for this reason, similar reasons. For the income, corporate spreads right now are still very, very tight. Have had a pretty big sell-off in the third and fourth quarter. In our opinion, there's still more widening to happen. If you look at the amount of leverage in the investment grade market right now, it's the highest it's ever been. Obviously, with the Bristol Myers buying Celgene or talking of buying Celgene, a lot of the leverage is going to go through the roof on Bristol Myers. So we're very cognizant of the amount of leverage in investment grade debt, and we'll continue to any cash flow or bonds that are needed will be more in governments and agencies. And very similarly, on page 28, due to the portfolio's shorter duration versus the benchmark, in most interest rate scenarios, the portfolio generates positive total return. The only one being in a parallel up 200, probably highly unrealistic from this point in the next 12 months, but that's the only one in which you'd have a negative total return. then the next several pages, 29, 30, 31 through 33, are the individual stocks held in the portfolio. And very similarly, on page 33, American Tower as well as Prologix are the REITs that were added to the portfolio in the fourth quarter.
What's the yield on those REITs?
The yield on those REITs, so American Tower is about 2%, and Prologix is about 3.25%.
Okay, I see it right here.
And on page 34, looking at the scholarship account, total market value is about $216,000. Asset allocation on the left side, so cash, enhanced cash is about 10% of the portfolio. Fixed income is 25%. Equities are about 65%. Again, versus that 70% target. So we definitely have, similar to the other two portfolios, we've reduced the weight to equities. And probably at some point go back towards neutral of 70, but not ready to do that just yet.
What are you looking for that would move you in that direction?
I think we'd want to see a little more of the fourth quarter earnings come out to see what the sentiment is and what earning revisions will look like. Right now, if you look at the price of the S&P at 14 and a half times earnings, considering you had strong 23% earnings growth in the third quarter, so the market is sort of skeptical. Obviously that 23% earnings growth last year was driven by the tax cut. So the comps in 2019 are going to be harder. So you're not going to grow 23%. You're probably going to grow, I think, 6% earnings growth. So at some point, we think the market will readjust itself. But we would probably want to see more of fourth quarter earnings come out, what forward guidance looks like. With Apple's pre-announcement, not ready to jump in just yet. But I think at some point, calm and normalcy will return to the markets. In early December, we put our 2019 outlook for the markets. We'll probably have to adjust it as, the market sold off more. But we're thinking more modest returns for 2019, more, single digits, low to mid single digit returns. I think that's probably somewhat realistic. You probably will have a strong quarter here, but it probably averages out to low to mid single digits for 2019.
Any specific sectors, Eric?
Probably more defensive. We'll probably look, maybe not so much in finance, but more in consumer side, and probably looking a little more, adding some more REITs as well as some more utility names to the mix.
Okay.
So in the scholarship on turning to the performance on page 35, so very similar to the other two accounts, year to date up 4.15% versus its benchmark of 1.55%. A lot of obviously those outperform returns are being generated by the equities. Equities are up 6.39% versus the global benchmark of 2%. And the S&P 500 of 5.11. Again, that's through November 30th.
Yeah, we've seen these previously.
And turning the page to look at the attribution analysis. So selection effects, so again, very similar to the other two portfolios. The stock selection is what's driving the returns more than, specific asset overweights or underweights sectors. And if there's no additional questions on those three portfolios, I will turn it over to Lindsay, who can start on the Merrimack Water on page 43.
Okay.
Eric, are you going to stay on the phone or should we disconnect?
I can stay on for a little bit more.
Okay.
I may have to, I'll interject if I have to run somewhere.
Okay.
Great. Okay, so Everybody good to jump into the CD portfolio accounts? Great. So the first one we have here is the Merrimack Water account. We have, as Eric mentioned, we've recategorized our cash account, so it's cash and enhanced cash. So that includes anything that has a T-bill that's less than a 1-year maturity. So it looks a bit higher than it has in the past at 1.7 million in cash, but that's actually including 1 million in T-bills that are due to mature within the next year as well. So just because that is a shift from how we've categorized it in the past. So currently, the market value of this portfolio is $5.7 million. The estimated portfolio yield is a 1.8%. The beginning market value was 4.9 million. Net contributions were 708,000. Earned income 91,000. And market depreciation was 9,700. So ending market value is 5.7 million. As far as cash needs go, we currently have about 700,000 in actual money market cash at this point. Just wondering what the cash needs are for the year. I think that we typically try to run it around 300,000 in cash. So with the 1 to 5 year CD ladder, as well as adding in those treasuries in the front end, as we've done over the past year.
Okay. I think they're gonna be expending their cash much faster this year. They've got some pretty big, well, they want to put filter plants on all the wells. So I think they're gonna try to expend their capital.
So how much does all that add up to?
Well, I
They
think,
put filter plants on every well. And how quick can they do that?
how quickly can they do that? You know, that's, how quickly do they want to do it versus how
1.7
quickly?
million here, and it's all short,
Yeah.
less than a year. And obviously, that's, you're not gonna be able to
Well, I think they're gonna be,
deploy all that capital, or,
right.
Yeah. They didn't give me any specific feedback when I wrote to them and said we're gonna be discussing that today.
Yeah, they're gonna be looking for more volatility.
I think any major projects are gonna go through town meeting or water district meeting in March, and then perhaps be either loans or bonds rather than the system development and the land acquisition that we have here for capital reserve funds. So I don't see huge withdrawals, but I think if we kept 300 before, I think we ought to be in the closer to the $500,000.
500,000?
Yeah, I think so. At least until March, we'll find out more about their
Right, yeah.
plans. There's going to be some petition warrant articles on the annual meeting this year. There's no telling what the result of those things will be at this point, because they haven't been put forward.
I'd say when things mature, I'd continue to buy like T-bills and so forth that are 6 to 9 months out, you'd probably be fine.
Okay.
Because I know they're paying, 2.3 type of,
So the 6 month as of yesterday was at a 248. The 1 year was at a 251. So a 9 month is probably right at a 25 in there.
so I'd say.
6 and
until we
9.
Get more information, stay in the 6 to 9 month
Sure.
range. Because it's a pretty good ladder, right?
Yeah, it
So
is.
they're gonna be turning over almost monthly probably, right?
Not quite monthly. As far as the T-bills go, we do have a maturity happening in January, and then the next one happens in May. And for the CD portfolio, we have 250 coming in January, another 250 in February, and then the next one after that is in July.
Yeah, you should be good then.
Yeah, so it looks like we have about 1.5 million coming due by May of this year, so continue to reinvest that in the 6 to 9 months
Well, I think you should keep, like Chris said, target 500,000, so,
in cash.
yeah,
Yeah.
cash or close equivalents.
Yeah, absolutely, we can do that.
So you're gonna have more money to invest than 500, so you can
Yes,
go
exactly.
longer on some of that money.
Yeah, great. So continue with the 1 to 5 year ladder in CDs as we've done in the past for this portfolio then? Okay, great. Moving on to page 44, the performance details as of November 30th. As Eric mentioned, we'll email out the year-end 2018 numbers once the audits come back. On a year-to-date basis, this portfolio returned 1.18% versus the Barclays Intermediate Government Credit Index down 45 basis points. Lipper Money Markets returned 144. Moving on to page 45. This is the list of the fixed income holdings as of the 31st of December. So you can see the portfolio has a duration of 1.2 years, and the current yield to maturity is 2.7%. Page 46.
How do you,
Yes?
on these different CDs,
Yes.
I mean, I can read down the list as, a lot of banks we've never heard of. I mean, I assume they're all domestic because I brought it up in a previous meeting.
Yes.
Why
they
don't you
are
buy
all
Bank of
domestic.
China because they always pay a few more basis, 10 basis points or something like that, and they're all FDIC insured. And somebody said, well, that's because if they did go belly up, it'd take longer to recover the money or something to that effect.
Yep.
So my question is, I'm looking down this list, some of these names are obviously household names, others are not as much household names. How do you choose one over the other? Because I've looked at all these broker-offered CDs, and it's pretty random. So how does Cambridge Trust say, hey, I'm going to buy Whitney Bank, Gulfport, Mississippi versus Bank, I can't even pronounce it, Lumi, USA, New York, New York.
Yeah,
How do you choose that? Is it just on yield or in maturity, or is it on,
Combination
or
of
do you look at the
factors.
quality of the institution?
Yeah.
Or how do you do that?
So we receive brokered CD runs, so we can see what the current offerings are out in the market. So we do look at yields to make sure that we're getting the best yield based on what the maturity needs are for the portfolio. So as we're building out the 1 to 5 year ladder, we do want to try and make sure that there's pretty consistent cash flows coming off the portfolio so that we can reinvest it, or you can use it for liquidity needs as needed. Once we figure out where we want to invest the cash based on the yields and the maturity factor, we subscribe to a service called Kroll Bond Ratings. So each of these CDs has a rated letter grade from the Kroll service. And it goes back historically, so we can see how they are rated compared to one another. So for banks that are riskier, they're going to have a lower rating, and those aren't ones that we would necessarily want to invest in. So we typically try to invest in those that are graded B or higher.
Even though they're all FDIC insured?
Yeah, because if the institution were to go under, it would take longer for you to get your investment back, as well as we really want to make sure that this portfolio is secure. So trying to avoid any sort of defaults is a high priority. We also look to make sure that the institutions have a large deposit base. So we don't want to be investing in any small banks necessarily, because those can also be riskier.
Good.
That's consistent with our policy, right? But You don't have the ratings here on the sheet. That
No,
might-
I don't.
Might
We
give
can
us a
include
better
that, though.
indication of,
Okay. Let me check to see if we can include that. But we check all of the ratings at the time of purchase and then on an ongoing basis for monitoring.
So in summary, if there was a CD, if there were two banks offering CDs with a maturity of July 1, hypothetically,
Mhm.
and one paid 2.0% and one paid 2.1,
Mhm.
but the 2.1 had a lower rating, you would more than likely select the 2.0% return CD because of quality?
Potentially.
I mean, you-
It would depend on the institutions. So, like you said, we don't really like to invest in international banks because of the time factor if something were to default. But it also has to do with the FDIC insurance limits. So we can only have up to $250,000 invested in any one CD issuer. So if, for example, there was something that was being offered at a 2.1%, but we already own the name, we wouldn't be able to purchase that specific FDIC issuer number. So we'd have to look at a different issue to invest in.
Sounds reasonable.
yeah, I'm thinking, is there a tipping point where if the yield were so high that we would go international? You know,
No, I wouldn't. I mean, we're in this for protection of, preservation of capital, not for yields on.
do they rate international banks?
They do.
So if they had a high rating, what would be, I mean, that would lower the risk.
Don't
rate.
think they're on the approved list.
Okay.
Now, I don't know what happens when you come to the guys down the street.
TD, you're Canadian?
TD Bank is one, Royal Bank of Scotland, which
That's right,
owns
yeah, Citizens.
Citizens.
Citizens. Yeah, I don't know if we consider that truly international, the way it would be something that's less common to us, but it certainly has that international flavor.
Yeah. There's gray lines there, yeah,
Yeah.
interesting.
But the long and the short of it is, FDIC insured is the key, or U.S. government securities, and that's what
Right.
we're limited to.
I appreciate that.
Moving on to page 46, this is another shock analysis. So on a total return basis, the portfolio would outperform given any scenario, which is that first line. The next pages 47 through 49 are listing out the individual issues that are held within the portfolio, so I'll skip over that. Page 50 is the Merrimack Municipal account. So this one, we add the recent cash inflow from the deposit, as well as a $250,000 T-bill. So on a total market value basis, this portfolio is $7,289,927. About 53% of that is currently invested in CDs, and the remaining 46 is that combination of T-bill as well as the money market funds, including the cash that was recently deposited.
So how much of this money, Tom or
Yeah.
Chris or whatever, of this 3.389 do we need to keep very liquid versus could they ladder some more CDs out on that?
Well, we're gonna need between 1.5 and 2 million in June, which is what we always do. Basically, the town rarely takes money out of capital reserve funds midterm. They take everything out of working capital, and then we reimburse it in June. So the 1.94 million that we deposited last week, we can do something with for not quite 6 months, 90 days. Plus working in with the rest of the ladder. So,
So anything over 2 million in this cash and enhanced cash account could potentially be stretched out a little bit to get a higher rate of return? Is that a correct assumption?
pretty much, yeah.
We've traditionally done a 1 to 3 year ladder in this portfolio for CDs. So is that okay to continue with that?
I think so.
Okay.
One of the things that we should perhaps be questioning is the town gives us money for capital reserve funds in December. And the fiscal year starts July 1st. So my question would be, since we pay half our taxes in July, should we be getting that money in July and have to work for 6 months instead of waiting until December and then giving it back 6 months later?
That makes,
And that's something
yeah.
we'd have to take up with
Yeah,
town
here's-
council, because I know that Paul is working the numbers on the working capital account as well to get an extra 1/10 of a point here and there.
that actually makes sense. I mean, here's the money coming in, here's,
So that's not something we're gonna resolve today, but it is something that we should perhaps take a look at. And the town council is holding a public hearing, is it, was it last night? Help me out, Tom, when is the town council talking about changing the budget proposals to do capital reserve funds on budget line items instead of special warrant articles?
I'm not positive. I think it's upcoming. I don't think it's happened yet.
This is kind of a side issue, but the laws were changed, or potentially changed, to require capital reserve funding to go through a special warrant article instead of a line item on the budget. And the rationale there, I think, from the state point of view, was if you put it as a line item in the budget, the selectmen had the opportunity to say, well, we're not gonna fund that after all, even though it was passed in the budget. We're gonna use that money we're gonna put it into a different line item. Whereas if it's a special warrant article, they have to do what the warrant article says. So I think there were some towns that were trying to have a little more control over what the selectmen were doing with the funds at hand.
by the way, I've gotta be out of here by 10:30. I noticed that our meeting's
Okay,
going on pretty much, that's another hour.
all right, let's move on. Anything else on the town?
Let me just see. Performance details for it on page 51. On a year-to-date basis, returned 1.36% versus the 1.44 for Lipper money markets, and negative 45 basis points for the Barclays Intermediate U.S. government. Same as in the water.
Is the reason why we returned less just because we had a shorter duration of our holdings, or?
As rates have moved up in the past year, we've continued to hold CDs that were purchased in the past, so they have a lower yield. So as the reinvestment occurs, we'll be able to get higher rates for that money that rolls off. But that's part of the reason for that. On page 52 of the fixed income holdings, Modified duration is 0.91 years, so less than 1 year total duration for that. Yield to maturity is a 2.6%. As you can see, we have a lot of money coming due within the first 6 months of the year. So we should definitely be able to reinvest that into the CD ladder, as well as have the 1.5 to 2 million ready for June. Page 53 is the shock analysis. Very similar to the water portfolio. All the scenarios are positive on a total return basis. Page 54 through 56 are the individual holdings details as of the end of December. So I'll just skip over that.
What is BMW Bank? Is that a domestic holding or is that a German holding?
It's a domestic holding, so it's the
What does BMW stand for?
BMW, like the car manufacturer. So it's the
So they have a financial group that's domestic? That
yes. It's they're definitely FDIC insured. I can look more into the specific details.
I'm just
for you.
curious.
Yeah.
You know, I'm not trying to play devil's advocate, but I was wondering if that was some kind of German thing. And we're talking about domestic CDs.
Baltimore, Maryland, Washington Bank.
Which one is that?
It's fourth on this list of page 54.
54. Right, the BMW. But the Baltimore, Maryland, is that?
I'm making that
No,
up.
no,
Oh,
no,
you
no,
mean-
no, no,
okay,
no, no.
sorry.
That's like BWI.
I can get you the specifics for what
I mean,
the
just, I'm just
BMW
curious,
is.
because we're talking about like whether
The
the
international
domestic or
factor.
international. I'm not really concerned about it at all, but is that like something directly, is that BMW like the car, or is that some other BMW that
Eric, are you still on the line?
sounds like he?
Yes, it's the financing arm that from BMW. So it's like the banking of BMW. So when you finance through a car through BMW Financial, so that's essentially the bank behind it. From what I remember, it's got a very high rating of, I think it's, LACE of, high B to A rated, and in IDC, which is another rating service, is close to 300, which is the highest. So it's a very, very strong financial entity, and I believe it's based out of Utah. I could be wrong, but it is, from my recollection, is domestic based.
Okay.
I can get the specifics on it though and send it over to you as
Just
far
send
as
an
where it's.
if you want to just send us all an email, or Chris an email.
But not every BMW owner pays in cash? Wow.
The dealers take their floor plan that way.
Oh, I see.
It's probably a great holding. I'm not disputing that it's not a good holding. I'm just curious.
No, absolutely. It's a great question.
Moving.
So I'll send that to Judy and you can. Sure. Great. On page 57, we have the Merrimack school account. So this currently has $411,000 in cash and cash equivalents and $198,000 in fixed income CDs. Currently investing in a 2-year ladder. Just to confirm that's still okay.
They're gonna be giving us $150,000 sometime in the next week or two. And then they're gonna ask for 110 of it back, I think, in March.
Need 110 in March. Okay. In addition to, I think we typically keep about 200,000 in money markets in this account.
Yeah, which is a pretty high percentage because
It is.
they don't have very big holdings.
Yeah.
But I think that's okay, yeah.
Okay. Great. So total market value for this account is $610,000. Estimated portfolio yield is just under 2%. On page 58, the total year-to-date yield through November 30th is 1.35%, versus the 1.44 for the Lipper money market and negative 45 basis points for the Barclays intermediate government credit. On page 59, you can see the fixed income holdings. This portfolio has a 0.81 year duration, and the yield to maturity on the account is 2.6%. Again, moving on to page 60 for the shock scenario. All the different scenarios show positive performance. And then page 61 through the end of the book are the holdings details, as well as the different indices and benchmarks breakdown.
If you're going short-term nowadays,
Mm-hmm.
I mean, it's almost, you're better off going with T-bills, because T-bills are paying more than a lot of bank CDs and so forth, if you're talking less than a year duration.
Yes.
Do you agree with that?
Yeah, the 1 year CD rate is about at 2.6 versus the 1 year Treasury, which is at 2.51. So you're not really getting that much more for going into CDs versus Treasuries at this point, on an equal maturity basis. So I think that both of them are good scenarios to invest in, given that they're both backed.
I guess there's no tax implications
For the CDs?
with the municipal account,
Right.
so it doesn't really matter, but I don't know.
You do run into the $250,000 limit, though, on the CD side. So
T-bills, you know.
T-bills, if you want to put more money to work at a given rate, you are able to put more to work at one point in time. And T-bills are also really good for trying to match up cash flows that are required. So both are very useful, and given that they're yielding very similarly on the 1 year basis.
Well, the other thing about T-bills is they are marketable, correct?
They are,
So, I
absolutely.
mean, a
They're
CD,
very liquid
a
market.
CD, you know, if you don't
You
hold
got
it
a
to maturity,
prepayment problem.
but T-bills are marketable.
Mm-hmm.
And the CD, if you sell it before maturity,
You're subject to a
may
penalty.
suffer a penalty.
Absolutely.
I'm just asking the question for our audience out there that's watching this TV.
Oh, absolutely.
Yeah.
Yeah.
Our huge
Um,
audience.
Once you move out into a 2 year CD, you're getting a 2.8% versus a 2 year Treasury of 2.4%. So you can see that you're picking up more yield by going into a CD at that point. But on the 1 year basis, you are only picking up about 10 basis points. And given the liquidity factor, as you mentioned, you know, it makes a lot of sense to do Treasury bills at that point as well.
Very good.
Thank you very much.
Welcome.
Eric, are you still with us?
I'm still here, yes.
Okay,
Go
well,
skate, Eric.
Thank
Make
you,
it
Eric.
on the team.
He's skating in about an hour and a half, so I think they're actually across the street playing pond hockey, so I'm sure their game's gonna go really well after this.
Is it still that cold?
Lake
All right,
Placid.
Eric, thank you.
Oh, Lake Placid, yeah, okay.
Thank you,
up in
Eric.
New York.
Thanks, Eric.
Thank you, bye-bye.
Yeah,
Bye.
well, that's right.
Okay, well, you're welcome to stay, but I think we gotta move on with the rest of the agenda.
Great.
We pass out the spreadsheets. They are for the November 30th period. We don't have December's available yet.
Okay.
I do have a question on the spreadsheets, and it may be premature since we're a fiscal year and most towns are not. But for the other towns that you deal with, for publishing this kind of stuff in the annual reports, this, with a superfine font, just barely fits onto a 14-inch page. And the books are usually published on an 8.5 by 11 page. Have you found a way to condense this stuff and still make it?
I have seen
Legible?
other towns just eliminate some of the columns and focus on the balance in the separate reserve funds.
If you have one of those,
Yeah, I'll send it to you.
might send to us and we can take a look at it, because we're in the midst of publishing our annual report.
Looks like you could get rid of purpose.
Yep.
Well, yeah, that's actually something required by the state, and we're going to need those columns filled in by your fiscal year end.
Can you put a code there instead of like a complete word?
They actually have pre-selected,
Fill-ins?
right, thank you. So, and we can send that on. I think we did send that on a couple of months ago, but we'll resend it.
Well, they're in the midst, we sent out a flyer on Justice Department website training. I don't know if anybody's taken a look at that yet. It was kind of an awkward time of year to start the program. Have you gone through that yet?
I have.
And
I've actually attended a couple of the sessions, and I'm signed up for next Fridays. It's helpful.
Okay, we'll look forward to maybe an email or something, get some of that information back to us, just how other towns are handling this.
Yeah, okay.
Because they all have to do it in March. Actually, the MS9's due March 1st for other towns, is that right?
For the December 31. I will tell you, the majority of the towns I work with are on June 30th.
Oh, is that
Fiscal
right?
year, yeah.
Okay.
But I'll get you a sample of their annual report.
Does anybody have any questions on the spreadsheets? Pretty self-evident.
Thank you for the donuts.
Oh, you're welcome.
Yes, thank you.
Thanks for all the information too. Very, very good.
Anytime.
Lindsay, I forget from time to time. A-Y, E-Y.
EY.
Thank you.
All right. My middle name's Lindsay, E-Y.
It is?
Yes,
That's the good way to spell it, right?
yes. And my daughter's E-Y.
Oh, perfect.
Yep. Well, yeah, she's named after me, so.
I think I'm good. Yeah, thanks, Chief.
Have a good day.
Thank you.
See you later. Take a donut for the road if you want one.
Thank you.
Thanks.
I'll give it this way.
Okay, like I said, I have a hard stop at 10:30.
Okay, we'll move on. Correspondence. We had a request from the library. We did that, we approved that last month, or November 30th. And they wanted that money in January, so we'll be sending that out in the next several days.
Okay.
We had some inquiry from Thornton's Ferry School and Reed's Ferry School, both of which are celebrating 50th anniversaries this year, but they were apparently looking more for information than they were for money. But they are at least aware that we might be able to support a project if they had one. So I'm just going to let that sit, that I've let you all know. We've had emailed correspondence with them just to let them know that we would be willing to listen to whatever proposals they might make. Watkins Prize Spelling Contest is January 18th. You gonna make the speech this year, Jack?
Well, I had to make it last year. I think it's your turn.
You're all ready. You're all prepped. Got the script and everything.
It was a very short intro. Maybe they appreciated that. I don't know. There were no questions, thank goodness.
Prize Speaking Contest, we made them aware of the funding available for that, but they
Yeah,
haven't
they
been able
don't.
to- seems to haven't been able to put the program together.
They used to be the highlight of my year.
Yeah.
Too bad.
Other mail that came in this morning, we got checks from the Watson Foundation, $5,000 for those scholarships, and $1,000 for the Lego League Fund. And I have a request, first one of the year from last year's scholarships requests that come due in January. So I have a request for one of those. And what I think I'd like to do is just have a blanket motion to authorize payment of those scholarship requests as they come in, rather than making them wait for a month or two for our next meeting.
I think it's good. I'll make that motion.
Second it.
All in favor?
Aye.
Aye. And does anybody else have anything that's exciting? Oh, correspondence. I have September, October, November, December copies of Dividend Investor. Anybody want some?
I'll take the late, oh,
I'll take one of them, but I
We'll
don't
fight
have
over
them
them.
all.
Give one to Tom.
oh, okay. September, October. Tell you what. Can I have December?
Sure. You want any particular month, huh?
Chris, are you intending to make that spelling contest?
That's the plan.
Okay, great.
Want them all, or any of them, or?
Yeah, I sat next to Marge Chaffrey last year, but you get to see her every Thursday morning anyway, so.
Yeah, take October.
Okay.
So that January 18th. I don't know what day of the week that is.
That was a Friday, I believe.
Okay.
I got it marked down here.
That is a Friday.
That is a Friday, okay. Yep. That's at 8 o'clock in the morning on Friday the 18th.
Okay. And you'll be in Florida that day.
Yes, I will not be there.
Okay. We'll still post it as an event, just so that people know we're out and about. And I don't have anything else in correspondence. Anybody else have anything that's come over the transom?
Not I.
What's interesting about the ferry schools being 50 years old, how time flies. I had lunch with Barbara DeVore, who the butterfly garden that we built was named after. And she didn't mention anything. Do you want me to see if I can get some advanced intel on what they might want?
Well, they contacted me
Uh-huh.
because they were actually, when I thought they were looking for money, what they were really looking for was, who do we call to get amusement rides, bounce houses?
Oh, okay.
So apparently they don't have a need for money.
They did something similar. Trying to think, I've been in this job for 20 years now, where they had a celebration at the 30th.
Or 25th.
But I can remember something similar to that, them getting rides and bounce houses.
Can we, maybe request that somebody from the MVD come and visit us soon, so we understand, like Jack alluded to them having some major projects, or
Right.
can we have somebody come and tell us, like, the timeline and what they, how they lay out the expenditures and that sort of thing?
I
Maybe
think
next,
that'd be a great idea.
maybe next meeting?
Next meeting is February 15th. Works for me.
Works for me.
Yep.
We'll see if,
See if Ron Minor or
But I think we should tell him right
I
up.
want Joe Comer, he's the chairman of the
Chair,
board.
Joe's the chair now? Okay,
We'll leave it up to them,
maybe both.
yeah.
I think we should put him on the spot a little bit and be real specific with them. Hey, listen, we're trying to manage your money, and we don't exactly understand what you're gonna be doing this year.
Yeah, okay. I will contact them and see what we can come up with. Other than that, next meeting is March 15th. and-
February 15th?
February 15th and March 15th, yes.
Okay.
I don't have anything else. Any other new business?
Wow,
Anything we need to return to? Old business?
I didn't mean to rush everybody. We have plenty of time here.
I think we're good.
Yep, I only have to get to Milford by 11. That was my
Oh,
hard stop.
I motion that we adjourn.
I second.
all in favor?
Aye.
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 Yeah, it's funny, I was going back over